Welcome to Day 4 of Technical Analysis 101. This session is Momentum Oscillators 2, covering 5 more ways to measure the pace of price movement. The sham momentum oscillator, rate of change, Williams percent are the stochastic momentum index, and the Detrended price oscillator. Day 2 gave you RSI and MACD as your first pass at momentum. Today we come back to that same underlying question. How fast is price moving? And answer it 5 different ways before we continue. The same standing note from every session in this course. Dreamlit Equity Research and its instructors are not SEC registered investment advisors, and nothing taught today. The sham momentum oscillator, rate of change, Williams percent are the stochastic momentum index, DPO, or anything in the advanced module. Constitutes investment, financial, or legal advice. All of it is presented strictly for educational and skill-building purposes. Dreamlit Equity Research bears no responsibility for investment decisions, trading losses, or damages that result from how you apply these concepts in live markets. That application and that risk belongs entirely to you. If you decide to trade or invest using any tool from today's session, please consult a SEC registered investment advisor or conduct your own independent due diligence first. My role today is simply to build your understanding of how these 5 oscillators work and what each one actually measures. With that, let's get into the material. A quick reminder of where we sit in the 6-day arc. Day 1, complete, gave you foundations and moving averages, the simple and exponential moving averages, and basic trend concepts. Day 2, complete, gave you momentum oscillators 1, RSI and MACD. Day 3, complete, gave you volatility and trend strength, Bollinger Bands, ADX, and the Commodity Channel Index. Day 4, where we are right now, is Momentum Oscillators 2, the sham momentum oscillator, rate of change, Williams percent are the stochastic momentum index, and the Detrended price oscillator. Day 5 moves into volume and adaptive trend tools, Chaikin money flow, an elastic volume-weighted moving average, zero-lag EMA, and parabolic SAR. And Day 6 closes with a strategy and fundamental crossover, the Piotrowski F-score, combining signals across the whole course, and a capstone project. Today is a second, deeper pass on the same momentum question. Day 2 opened. You're refining a question you've already started answering, not starting a new one. Here's exactly what we're covering today in 4 blocks. First, CMO and ROC. 2 more direct ways to measure the pace of price change. One a symmetric oscillator built from raw sums, the other a pure percentage change with no smoothing at all. Second, Williams percent R and the stochastic momentum index. Both refine the overbought oversold concept from RSI, but with different scaling and different sensitivity to where price sits in its recent range. Third, the Detrended price oscillator, DPO, the one tool this week deliberately built to strip trend out entirely, so it can isolate the shorter cycles hiding underneath it. And fourth, a strategy spotlight on multi-oscillator confluence. What it means and doesn't mean when several independently built momentum tools agree at once. By the end of today, you'll be able to compute all 5 indicators by hand, read what each is telling you at a glance, and in our advanced module, use them the way a systematic desk actually would. Let's revisit momentum before building a single new formula. Day 2 introduced RSI and MACD to answer the question, how fast is price moving? No single momentum tool is perfect for every stock or every time frame, because each formula weighs recent price action slightly differently, which changes how sensitive and how noisy the resulting reading is. Today's 5 building blocks split into 3 groups. CMO and ROC are simpler, symmetric alternatives to RSI. One trades averages for raw sums, the other drops, smoothing entirely. Williams percent R and SMI are range position oscillators. They ask where today's close sits within its recent high-low range, just measured from different reference points. And DPO removes trend entirely to isolate cycles. Zooming out to the 4 families of technical indicators, trend, Day 1's focus is done. Momentum, Day 2's focus, is what we're deepening today. Volatility, Day 3's focus is done. And volume, still ahead of us on Day 5, asks how strong the participation behind a move actually is. Today sits squarely inside the momentum family, a second, more textured pass at the same question. Part 1 of today's session, CMO and ROC. Two simpler, more direct ways to measure how fast price is moving than the RSI you built on day 2. CMO trades RSI's average gains and losses for raw sums on a symmetric scale. ROC drops the averaging altogether and simply reports percentage change. Let's build both from first principles. The Chande momentum oscillator is RSI's more direct cousin. Instead of averaging gains and losses the way RSI does, CMO works from their raw sums, producing a symmetric scale that runs from -100 to +100, centered on 0. Here's the formula. CMO equals 100 times the sum of gains minus the sum of losses, divided by the sum of gains plus the sum of losses. Sum of gains and sum of losses are totals over n periods, not averages, totals. The standard lookback is 9 or 14 periods. For our hand-worked example, we'll use 5. 3 quick facts. The scale is symmetric. -100 means every period in the window was a loss. +100 means every period was a gain. Because it uses raw sums instead of smoothed averages, CMO reacts a touch faster than RSI does to a fresh shift in gains versus losses. And the conventional reading is above +50 as overbought, below -50 as oversold. Compare that directly to RSI. RSI runs 0 to 100 with no genuinely meaningful zero line. Since its midpoint is 50, CMO runs -100 to +100, so 0 itself is a meaningful crossing point. Both tools measure the same underlying idea, gains versus losses, but CMO's symmetric, zero-centered scale makes it easier to compare across very different instruments. Let's hand calculate CMO on concrete numbers. Assume a stock's 7-day closing prices 100, 102, 101, 104, 103, 106, and 105. Step 1. Compute the daily price changes. From day 1 to day 2, close rises from 100 to 102, a gain of 2. Day 2 to day 3, close falls from 102 to 101, a loss of 1. Day 3 to day 4, a gain of 3, up to 104. Day 4 to day 5, a loss of 1, down to 103. Day 5 to day 6, a gain of 3, up to 106. And day 6 to day 7, a loss of 1, down to 105. Step 2. Sum the gains and the losses separately. So, the sum of gains equals 2 plus 3 plus 3, which is 8. SD, the sum of losses equals 1 plus 1 plus 1, which is 3. Step 3, plug into the CMO formula. CMO equals 100 times the quantity 8 minus 3, divided by the quantity 8 plus 3. That's 100 times 5 over 11, which comes out to 45.45. Now, turning that number into judgment. Overbought and oversold. CMO above +50 signals overbought, a possible sell signal. CMO below -50 signals oversold, a possible buy signal. Our reading of 45.45 sits just under that overbought line. Strong upward momentum, not yet at the extreme. Trend strength follows the same zero-line logic as everywhere else this week. CMO above 0 means more upward momentum, bullish. CMO below 0 means more downward momentum, bearish. Here's how compactly this comes together in R, using the QuantMod package. 3 lines after loading the library. Pull NVDA's last year of daily data with get symbols. Plot the candlestick chart with chart series, and layer on the 14-day Chande momentum oscillator with a single call to add CMO, N equals 14. What you're looking at on screen is exactly that output on real NVIDIA data. Candlesticks on top, volume underneath, and CMO's raw 14-day reading oscillating in its own panel at the bottom, swinging repeatedly between roughly +50 and -50 as the stock's multi-month advance unfolds. Notice CMO doesn't stay pinned near an extreme even during NVDA's strongest advancing months. It oscillates around a rising bias, precisely the more upward momentum than downward. Reading the formula is built to produce, rather than sitting glued to +100. What you're watching now is a live, monthly updating build of multi-oscillator confluence on real NVIDIA data, for panels growing together as each new month is added. Price sits on top, with a green or red dot dropped on it any month where several oscillators vote bullish or bearish together. The second panel overlays CMO's 14-period reading against ROC's 12-period reading on a shared axis, each with its own plus 50, minus 50 reference band. The third panel adds Williams percent, R, and SMI, each on their own dashed reference lines. And the vote strip along the bottom counts how many of these 4 oscillators agree in any given month, with a dashed line marking 3 of 4 confluence. Gold where that bar is cleared, gray where it isn't. Watch how rarely the gold bars actually appear. Real confluence is the exception, not the rule, exactly the caution this course keeps repeating. By the most recent month, 3 of 4 oscillators are voting bullish at once. ROC reading 14%, percent are at -3, SMI at 94, all push toward their overbought extremes together. That's the entire teaching point of this chart in motion. Agreement across independently built formulas is real information, but watching how infrequently it shows up, month after month, is what keeps you honest about how much weight it deserves. Rate of change, or ROC, is the simplest momentum measure of all, the percentage change in price versus end periods ago. No averaging, no smoothing, just pure percentage change. Here's the formula. ROC equals the quantity current close minus the close end periods ago, divided by the close end periods ago, times 100. The standard look back is 12 periods. We'll use 5 for our hand-worked example. 3 quick facts. ROC is expressed directly as a percentage, which makes it trivially easy to compare across stocks trading at completely different price levels. It's unbounded and centered on 0. Positive means price is higher than end periods ago. Negative means lower. And because there's no smoothing at all, ROC is the most reactive tool in the course so far. It responds to a price move immediately, with none of the lag a moving average introduces. Why do traders still reach for something this simple? 3 reasons. Universality. A 5% ROC means the same thing whether the stock trades at 50 rupees or 5,000 rupees, unlike a raw price-based indicator. Simplicity. No averaging means no lag from smoothing. What you see is the literal percentage move, nothing more. And it's a natural screening tool. Because it's simple and directly comparable across names, ROC is widely used to rank and screen an entire universe of stocks by momentum, an idea we'll build out properly in the advanced module. Let's hand calculate a 12-day ROC. Track a stock's closing price day by day. By day 13, close sits at 115, and 12 days earlier, on day 1, close was 100. ROC equals the quantity 115 minus 100 divided by 100 times 100. That's 15 divided by 100 times 100, which is 15%. Move forward one more day. Day 14 closes at 117, and 12 days earlier, day 2, closed at 102. ROC equals the quantity 117 minus 102 divided by 102 times 100, 15 divided by 102 times 100, which comes out to 14.71%. Notice the reading barely moved between the 2 days, 15% down to 14.71%, even though price kept climbing. That's ROC comparing today against a moving 12-day-old anchor, not against a fixed baseline. Turning this into judgment, 3 rules. Identifying momentum. ROC above 0 is positive momentum, price increasing. Below 0 is negative momentum, price decreasing. Overbought and oversold. A high positive ROC, conventionally above plus 10%, suggests overbought and a potential sell signal. A low negative ROC, below minus 10%, suggests oversold and a potential buy signal. And divergence. Price making new highs while ROC declines signals weakening momentum and a possible reversal. Price making new lows while ROC rises signals a possible bullish reversal. The exact same divergence logic you learned for RSI and MACD on day 2, just applied to a completely different formula. Same 3-line pattern in R. Pull NVDA's last year of data, plot the candlestick chart, and layer on ROC with that ROC. N equals 12. What's on screen is that exact output on real NVIDIA data, price and volume on top, and the 12-day rate of change oscillating underneath, unbounded and centered on zero, spiking sharply on the stock's fastest advances and pulling back just as sharply on its corrections. Notice how much choppier this line looks than CMOs did on the earlier R-code slide. That's the direct, visible cost of ROC slack of any smoothing. You get zero lag, but you also get zero noise reduction. Part 2 of today's session, Williams percent R, SMI, and DPO, where price sits within its recent range, and what's left after the trend is removed. Williams percent R and SMI both ask essentially the same question RSI asks. Has price stretched too far in one direction? But each measures the answer from a different reference point inside that range. And DPO breaks from every tool so far by deliberately discarding trend entirely to isolate what's left underneath it. Williams percent R asks a very specific question. Within the recent highest high to lowest low range, how close is today's close to the top? It uses the same high and low data you first worked with on day 3. Here's the formula. Percent R equals the quantity highest high over n periods minus today's close, divided by the quantity highest high minus lowest low over n periods times negative 100. Highest high and lowest low are simply the highest high and lowest low over the last n periods. The standard look back is 14 periods, and we'll use 5 for our hand-worked example. 3 quick facts. The scale is bounded, but inverted, it runs from 0 down to negative 100, rather than the more familiar 0 to 100 direction. The conventional reading is above negative 20 as overbought, below negative 80 as oversold. And conceptually, Williams percent R sits very close to a fast stochastic oscillator. If that name is familiar from other reading, this is effectively the same idea with a different sign convention. Reading the inverted scale in 3 bands. 0 to negative 20 is overbought. Close is trading near the top of its recent range. Negative 20 to negative 80 is neutral. Close sits within the middle of its recent range. And negative 80 to negative 100 is oversold. Close is trading near the bottom of its recent range. Let's hand calculate a 14-day Williams percent R. Track a stock's daily high, low, and close. By day 14, the 14-day highest high is 115, the 14-day lowest low is 95, and today's close is 110. Percent R equals the quantity 115 minus 110 divided by the quantity 115 minus 95 times negative 100. That's 5 divided by 20 times negative 100, which comes out to negative 25. What does negative 25 tell us? It sits inside the neutral zone, but on the stronger side of it, closer to the overbought threshold at negative 20 than to the oversold threshold at negative 80, meaning the stock is trading fairly close to its recent highest high. Turning this into 3 trading rules. Overbought and oversold. Percent or above negative 20 is overbought, a potential sell signal. Below negative 80 is oversold, a potential buy signal. Price reversals and trend strength. Percent R crossing back above negative 80 is read as a bullish signal, price recovering off its lows. Crossing below negative 20 is read as bearish, price weakening off its highs. And divergence. The same pattern one more time. Price making new highs while percent R falls signals a weakening bullish trend. Price making new lows while percent R rises signals a potential bullish reversal. One honest caution worth holding on to. Williams percent R can remain pinned at an overbought or oversold extreme for an extended stretch during a genuinely strong trend. So confirm it with RSI, MACD, or ADX rather than trading the extreme reading in isolation. In R, pull NVDA's data, plot the candlestick chart, and layer on Williams percent R with add WPR N equals 14. Unlike CMO and ROC, Williams percent R needs the full high, low, and close. Not just the close, which QuantMod pulls automatically from the OHLC data already loaded. What's on screen is that output on real NVIDIA data. Price on top, and percent are oscillating in its own panel underneath, repeatedly slamming up against its zero ceiling during the stock's strongest advancing stretches and diving toward negative 100 during its sharper pullbacks. What you're watching now is a live, monthly updating build of Williams percent are on real NVIDIA data, growing month by month across two synchronized panels. Price sits on top, with shaded vertical bands marking every stretch where percent R has pushed into an extreme, green for overbought, above -20, and red for oversold, below -80. Percent R itself sits underneath, with dashed reference lines at those same -20 and -80 levels. Watch how frequently the green overbought bands appear compared to the red oversold ones as the months roll forward. That asymmetry tracks directly with how much of this window has been spent in a genuine uptrend, and it's a pattern you can only see by watching the bands accumulate over time, not from any single reading. By the final month, percent R has settled back inside the normal range, neither pinned to the top nor the bottom of its recent high-low band. A legitimate, unremarkable reading, and a reminder that Williams percent R, like every tool this week, doesn't owe you an extreme signal every single month. The Stochastic Momentum Index, SMI, refines the exact same idea as Williams percent R, whereas the close relative to its recent range, but measures distance from the range's midpoint rather than from its edges, and in its full form, smooths that distance twice. Here's the formula in simplified form. First, compute the high-low midpoint. M equals the quantity high plus low divided by 2. Second, find the difference between today's close and that midpoint. D equals close minus M. Third, scale that difference. SMI is approximately 100 times D, divided by 1/2 times the quantity highest high minus lowest low. The full version of SMI double smooths both D and the range using exponential moving averages. We're using this single-pass version so the arithmetic stays hand-checkable. Two quick facts. SMI is roughly bounded between -100 and +100, centered on 0, and a positive reading means the close is trading above the midpoint of its recent range. Why measure from the midpoint instead of the edges? Williams percent R and the stochastic oscillator both measure distance from the range's edges, the high or the low. SMI instead measures distance from the center, which makes it less noisy right at the edges of the range and produces a cleaner, more decisive zero-crossing signal. In practice, SMI was developed by William Blau as a refinement of the stochastic oscillator, aimed specifically at traders who found the original too choppy in genuinely ranging markets. Let's hand calculate a 14-day SMI. For each day, compute the high-low midpoint, HLM, as high plus low divided by 2. Day 1's high of 105 and low of 95, give an HLM of 100. Day 2's high of 106 and low of 96, give an HLM of 101. Day 3's high of 107 and low of 97, give an HLM of 102. Then compute the difference between close and that midpoint. Day 1's close of 100 minus its HLM of 100 gives a difference of 0. Day 2's close of 102 minus its HLM of 101 gives a difference of 1. Day 3's close of 104 minus its HLM of 102 gives a difference of 2. Continuing this pattern out to day 14, with a high of 115, a low of 105, a close of 110, and an HLM of 110, the difference comes out to 0 again. And feeding that sequence of differences and ranges through the double exponential smoothing step gives you the final SMI reading for that day. The key thing to hold on to here isn't the exact 14-day number. It's the mechanism. SMI oscillates between -100 and +100, and a reading near 0, like the differences we just walked through, means the close keeps landing right at the midpoint of its own recent range. Genuinely neutral positioning, not stretched toward either edge. Turning readings into judgment. 3 rules. Momentum and reversals. SMI above +40 signals strong bullish momentum. Below -40 signals strong bearish momentum, and a zero-line cross in either direction is read as confirmation of that same direction. Overbought and oversold. SMI above +70 is overbought, a potential sell signal. Below -70 is oversold, a potential buy signal. And divergence. The same recurring pattern. Price making new highs while SMI declines signals a weakening bullish trend. Price making new lows while SMI rises hints at a potential bullish reversal. As with percent R, SMI can stay pinned at an extreme through a genuinely strong trend, so pair it with the MACD or ADX rather than trading the extreme alone. In R, pull NVDA's data, plot the candlestick chart, and layer on SMI with add SMI, using N equals 13, a slow period of 25, a fast period of 2, and a signal period of 9. The classic Chande defaults for this indicator. What's on screen is that output on real NVIDIA data, price on top, and 2 lines underneath, SMI itself, and its own exponential moving average acting as a signal line, in the same spirit as Mac's line and signal setup from day 2. Watch for the 2 lines crossing each other, which is SMI's own internal confirmation signal, distinct from the plus 40 and minus 40 reference bands we just covered. The Detrended Price Oscillator, DPO. Every tool so far this week has, in one way or another, confirmed this stock's trend. DPO does the opposite. On purpose, it deliberately strips the trend out, leaving only the shorter-term cycles that sit above and below it. Here's the formula. DPO equals the close from N over 2 plus 1 periods ago, minus the current N period simple moving average. That formula compares a past close, shifted back by N over 2 plus 1 periods, against the current SMA. The standard lookback is 20 periods, and we'll use N equals 5 with a shift of 3 for our hand-worked example. 3 quick facts. DPO is the only tool this week explicitly designed to ignore trend entirely, rather than follow or confirm it. It oscillates around 0 based purely on shorter-term cycles, once the trend's influence has been backed out, and it is not meant for direction. Treat it strictly as a cycle timing tool, not a buy or sell signal on its own. Here's the trick behind that shift. By comparing an old close to today's SMA, instead of comparing today's close to today's SMA, the way every other oscillator this week does, DPO approximately centers the moving average underneath the price action actually averaged. That removes most of the long-term trend's influence, leaving peaks and troughs that reflect shorter, more tradable cycles. Genuinely useful for estimating a stock's typical cycle length when it's range-bound, an idea we'll formalize properly in the advanced module. Because it deliberately ignores trend by design, DPO should never be used as a standalone trend or direction signal. Pair it with day 1's SMA or EMA for that. Let's hand calculate DPO on 10 days of closing prices. 100, 102, 105, 107, 106, 108, 110, 109, 111, and 113. With the standard N equal to 20. The shift would be 20 over 2 plus 1, or 11 periods. More than our 10-day window contains, so purely for illustration. We'll use N equals 6 instead. Step 1. Compute the 6-day, simple moving average at each point once 6 closes are available. By day 6, the SMA of the prior 6 closes comes out to 104.67. DPO for that day equals the close of 108 minus 104.67. which is 3.33. By day 7, the 6-day SMA is 106.33. DPO equals 110 minus 106.33, which is 3.67. By day 8, the SMA is 107.67. DPO equals 109 minus 107.67, which is 1.33. By day 9, the SMA is 108.5. DPO equals 111 minus 108.5, which is 2.5. And by day 10, the SMA is 109.5. DPO equals 113 minus 109.5, which is 3.5. Notice every single one of these readings is positive, even though price is simply climbing steadily through this window. That's expected, not a flaw. DPO is telling you the close keeps running above its own recent detrended average, which is a genuine, if muted, cyclical signal once you remember the trend itself has already been backed out of the number. In R, pull NVDA's data, plot the candlestick chart, and layer on DPO with that DPO, N equals 20. The shift of 11 periods is derived automatically from that N, so there's no separate shift argument to set. What's on screen is that output on real NVIDIA data, price and volume on top, and DPO's 20-period reading oscillating around 0 underneath, with no fixed overbought or oversold bands drawn, A direct visual reminder that unlike every other tool this week, DPO isn't built to flag extremes at all. What you're watching now is a live, monthly updating build of DPO on real NVIDIA data, 2 panels, growing together as each new month is added. Price sits on top, with the same length simple moving average overlaid, but deliberately displaced back on the time axis by DPO shift, the standard displaced moving average trick. At each date, the line shows the SMA value that will occur several trading days later, so it visually lines up with the close it's actually being compared against. The vertical gap between price and that displaced line is, mechanically, exactly what DPO measures. Underneath, DPO sits on a zero line only, no fixed bands, because DPO isn't built to flag extremes, it's built to isolate cycles. Every zero crossing gets marked, and once 2 consecutive same-direction crossings exist, the spacing between them gets labeled as a cycle length estimate. Watch the labels accumulate as the video advances. A run of tight 2 to 4 day cycles late in the window, following several earlier 15 and 16 day cycles. A visible record of how a stock's dominant short-term rhythm drifts as conditions change. Not a fixed number you could read off any single frame. Let's put all 5 of today's tools side by side on the same day 10 reading, because seeing their differences explicitly sharpens your understanding of each one individually. CMO runs -100 to +100, built from gain and loss sums, and reads 60.0 on day 10, strong. ROC is unbounded, expressed as a pure percentage change, and reads +5.6%, positive. Williams percent are run 0 to -100, measuring position against the range high, and reads -9.1, overbought. SMI runs -100 to +100, measuring position against the range midpoint, and reads 81.8, strong. And DPO, unbounded around the SMA, measuring cycles with trend removed, reads -0.8, trend excluded. Notice what actually happened here. 4 independently built formulas, CMO, ROC, Williams percent R, and SMI, all agree this stock is strong and stretched on day 10. The 5th, DPO, reads differently, not because it disagrees with the other 4, but because it was built from the ground up to answer a completely different question. That distinction is the entire setup for today's strategy spotlight. Our strategy spotlight for today, multi-oscillator confluence. When several independently built momentum tools agree, that agreement itself is information. The idea, in one sentence, count the votes. No single oscillator is reliable enough to trade on alone. But when RSI, CMO, Williams percent R, SMI, and CCI all independently signal overbought at the same time, the odds that this reflects genuine, broad-based strength rise sharply. In our day 10 example, RSI at 80, CMO at 60, Williams percent are at -9, SMI at 82, and CCI at 113 all read overbought or strong at once. 5 for 5. DPO, measuring something different by design, is the one exception, and that's expected, not a contradiction, exactly the point the comparison table just made. Here's the trader's caution, and it matters. Confluence raises confidence, but many of these momentum oscillators are built from the same underlying gain-loss or range logic. They aren't fully independent votes, even though counting them side by side makes them look that way. Pair oscillator confluence with a trend or volume check before treating it as a strong signal on its own. And in our advanced module, we'll go one step further and put an actual number on exactly how redundant these 5 votes really are. Before we close out the core session, for questions for you to work through in your own notes, we'll review them together at the start of the advanced module. Question 1. How does CMO's use of raw sums instead of averages make it different in character from RSI? Question 2. A stock's Williams percent R is -5. Is that overbought or oversold? And how do you know from the scale alone? Question 3. Why might DPO show a negative reading even while a stock is in a strong, established uptrend? And question 4. If RSI, CMO, Williams percent R, and SMI all signal overbought at once, does that guarantee a pullback? Why or why not? Take a few minutes with these before moving on. Let's consolidate today's core session into 6 takeaways. 1. CMO reworks RSI's logic with raw sums on a symmetric -100 to +100 scale, making cross-stock comparison easier. 2. ROC is the simplest, most reactive momentum tool in the course. Pure percentage change, with no smoothing at all. 3. Williams percent R and SMI both measure where the close sits within its recent range, from the edge and from the midpoint respectively. 4. DPO deliberately removes trend to isolate shorter cycles. It will disagree with trend-following tools by design, not by error. 5. Different formulas measuring the same underlying idea will usually agree. When several agree at once, that's confluence, and it raises confidence. And 6. No oscillator predicts direction on its own. All 5 tools this week describe the present state of momentum, exactly the same role RSI and MACD played back on day 2. Hold on to all 6 of these. They're the foundation the advanced module builds directly on top of. Looking ahead to day 5, volume and adaptive trend tools, covering Chaikin money flow, an elastic volume-weighted moving average, zero-lag EMA, and parabolic SAR. Chaikin money flow is our first genuinely volume-based tool in the course, measuring buying versus selling pressure rather than price alone. The elastic volume-weighted moving average and zero-lag EMA refine day 1's trend tools further, correcting for exactly the kind of lag we've flagged repeatedly this week. And parabolic SAR is a trailing stop-and-reverse system that adapts its own sensitivity as a trend matures. As a structural reminder, day 6 wraps up the course with a strategy and fundamental crossover capstone, combining everything from days 1 through 5 with the Piotrowski F-score into one testable framework. We're now entering the advanced module, how funds actually trade momentum. This is where today's session moves from reading one oscillator on one chart to systematizing momentum as a genuine signal across an entire universe of stocks, the way quant and hedge fund desks actually use the tools we just spent the core session building. 7 ideas beyond the textbook, and every one of them is built directly on top of day 4's 5 oscillators and day 3's ADX. Nothing new to calculate from scratch, only new ways to use what you already know. First, cross-sectional momentum ranking, trading a stock's momentum relative to a universe, not against a fixed threshold. Second, the information coefficient, or IC, how funds actually validate a signal instead of eyeballing whether it looks right. Third, volatility-normalized momentum, why an 8% ROC is rarely the same signal on 2 different stocks. Fourth, regime-conditioned momentum, gating momentum signals by day 3's ADX, so you trust them only when a genuine trend is present. Fifth, confluence, done properly, correcting the earlier vote count for the fact that oscillators aren't fully independent. Sixth, DPO and cycle length, using DPO's zero crossings to estimate an actual dominant cycle, not just a single reading. And seventh, a bridge to stage analysis, tying regime-conditioned momentum back to Weinstein's 4-stage framework from day 1. Let's start with cross-sectional ranking. Ranking, not thresholds. Every reading rule so far this week has asked an absolute question. Is ROC above 0? Is CMO above +50? A fund rarely asks that question. It asks a relative one instead. How does this stock's momentum rank against the other 500 stocks in the universe right now? Here's the formula. The rank of stock I at time t equals the percentile of that stock's ROC within the universe at time t. The practical rule that falls out of it: go long the top decile of ranks, short, or simply avoid the bottom decile. This is the raw ingredient of what the academic literature calls the momentum factor. This is not new math. It's the exact same ROC formula from earlier this session. The only change is comparing it across stocks instead of reading it against a fixed number on one chart. Why is this how funds actually trade it? 3 reasons. Thresholds drift. A good ROC in a roaring bull market is a mediocre one in a flat year, but rank is self-adjusting. It's always relative to what the market is doing today. It is quite literally the momentum factor, Jagadish and Titman's original momentum study, and the momentum factor inside the Carhart and Fama-French models are built on exactly this mechanism. Rank, then go long winners and short losers. and it scales. A single chart doesn't scale to 500 names, but a rank column does. This is precisely what turns momentum into a systematic, back-testable strategy rather than a chart reading habit. Let's rank a small, illustrative 8-stock universe by 5-period ROC. The exact same calculation from earlier this session, now run across 8 names at once side by side. AXN posts a 5-period ROC of plus 8.4%, ranking first, the 100th percentile. BRT posts plus 6.1%, ranking second, the 86th percentile. CDL posts plus 4.7%, ranking third, the 71st percentile. DFK posts plus 2.9%, ranking fourth, the 57th percentile. EQR posts plus 1.2%, ranking fifth, the 43rd percentile. FHT posts negative 0.6%, ranking sixth, the 29th percentile. GLM posts negative 2.3%, ranking 7th, the 14th percentile. And HYB posts negative 4.8%, ranking 8th and last, the 0th percentile. Applying the long top, short bottom rule, YXN and BRT, the top quartile, show the strongest relative momentum in the universe, candidates for a long position, regardless of what the absolute ROC number happens to be. GLM and HYB, the bottom quartile, show the weakest relative momentum, short candidates in a long short book, or simply avoided entirely in a long only one. And notice EQR and DFK sitting in the middle. No strong relative signal either way, which is itself useful information. Not every stock in the universe needs to end up in the book. What you're watching now is a live, monthly updating build of cross-sectional momentum ranking, run on a real 9-stock universe that includes NVIDIA. The top panel is a ranking race, a horizontal bar for every stock in the universe, sorted by its rolling rate of change reading each month, colored by momentum quartile, with NVDA's own bar marked explicitly so you can track it against the field. The bottom panel is NVDA's own price line, with markers dropped onto the months where it sat in the universe's top or bottom momentum quartile. Watch NVDA's bar physically slide up and down the ranking each month as the video advances. Some months it's near the top of the pack, other months it drifts toward the bottom, and the subtitle reports exactly where it landed and what the universe's leader and laggard were doing at the same time. By the final month, NVIDIA ranks 5th of 9, squarely in the middle of the pack, an ROC of negative 4.4%, well behind universe leader Microsoft at plus 21.3% and well ahead of laggard Tesla at negative 22.8%. That sliding motion, month after month, is the cross-sectional idea made completely literal. Momentum isn't a fixed number read off one chart. It's a moving position within a crowd. How funds actually validate a signal? Every claim so far this week. Overbought tends to mean a pullback has been argued qualitatively. A quant desk instead computes one number, the rank correlation between today's signal and the return that actually followed it. Here's the formula. IC equals the Spearman rank correlation between the signal at time t and the return from time t to t plus h. It's rank correlation, not price correlation. It only asks whether the ordering was right, which makes it considerably more robust to outliers than a raw correlation would be. Reading the number, an IC of +1 means a perfect ranking. An IC of 0 means no predictive power at all. In live, single stock equity signals, an IC between 0.02 and 0.08 is considered genuinely useful. Nowhere near the 0.9 a clean, hand-worked example can produce. A point we'll come back to directly on the next slide. Why does this replace it looks right? 3 reasons. It's testable. RSI divergence usually works as an opinion. This signal's IC over the last 500 trading days was 0.04 as a measurement. It can be wrong, and it can be checked. It's honest about weak signals. A well-known industry rule of thumb, Grinnell's fundamental law, says expected return scales with IC times the square root of breadth. Individually weak signals, meaning low IC, become useful only when applied across many stocks at once, meaning high breadth, which is exactly why the cross-sectional ranking from moments ago matters in the first place. And it compares signals fairly. IC lets a desk ask, is CMO or ROC the better signal on this universe as a genuine apples-to-apples measurement, rather than a subjective debate? Let's hand calculate an IC on the same 8-stock universe from a few slides back. Signal rank is today's ROC rank. Outcome rank is how each stock's forward 5-day return actually ranked. XN, signal rank 1, outcome rank 2, a difference of -1. BRT, signal rank 2, outcome rank 1, a difference of +1. CDL, signal rank 3, outcome rank 4, -1. DFK, signal rank 4, outcome rank 3, +1. EQR, signal rank 5, outcome rank 6, -1. FHT, signal rank 6, outcome rank 5, +1. GLM, signal rank 7, outcome rank 8, -1. And HYB, signal rank 8, outcome rank 7, +1. Every single difference has a magnitude of exactly 1. So every square difference equals 1, and the sum of those 8 square differences is 8. Now the Spearman shortcut, rho equals 1, minus 6 times the sum of square differences, divided by n times the quantity n squared minus 1, with n equal to 8. 1 minus 6 times 8, divided by 8 times 63. That's 1 minus 48 over 504, which comes out to 0.905. So IC is approximately 0.91 for this toy universe. Read that number honestly, though. This 0.91 is artificially clean, built from a tidy, alternating permutation specifically, so the arithmetic checks out cleanly by hand. A real single signal IC of 0.91 essentially never happens in live markets. 0.02 to 0.08 is the realistic range quoted a moment ago. Learn the mechanics here, on a toy example built to be tractable. Then expect much noisier numbers once you compute this on real data. The same ROC is not the same signal. An 8% 5-day ROC on a sleepy utility stock and an 8% 5-day ROC on a volatile biotech are not the same event, even though the formula spits out an identical number. Dividing momentum by realized volatility, a sharp ratio-like transform, makes signals genuinely comparable across assets. Here's the formula. Volatility-adjusted momentum equals ROC over n periods, divided by sigma over the same n periods, where sigma is the standard deviation of daily returns over that same n-period window used for ROC. Day 3's volatility machinery, reused here directly rather than built again from scratch. Let's walk 2 stocks with an identical raw ROC. Stock P, low volatility. ROC equals plus 8%, sigma equals 1.1%. Volatility-adjusted momentum equals 8.0 divided by 1.1. which is 7.27. Stock Q, high volatility. ROC also equals plus 8%, but sigma equals 3.4%. Volatility-adjusted momentum equals 8.0 divided by 3.4, which is only 2.35. Identical raw ROC on both stocks, but P's move came with far less chop behind it. P is the structurally stronger momentum candidate once risk is properly priced in. Exactly the distinction raw ROC alone can never tell you. Gating signals with ADX. Funds rarely trust a momentum signal uniformly. They condition it on whether a genuine trend regime is even present, using day 3's ADX as the gate. Here's what that conditioning actually looks like measured, not just argued. The information coefficient of a plain ROC signal split by ADX regime. In a choppy regime, ADX below 20, ROC's IC comes in at just 0.01, essentially no predictive power. In a transitional regime, ADX between 20 and 25, IC rises to 0.03. And in a genuinely trending regime, ADX above 25, IC climbs to 0.07, roughly 7 times stronger than in the choppy regime, and squarely inside the genuinely useful 0.02 to 0.08 range from a few slides back. This is an illustrative pattern, not a fitted result on any one stock. The shape, a weaker signal in chop and a stronger one in trend, is the point, not the exact figures. Why does the pattern make sense? In a low ADX, choppy market, ROC and CMO whipsaw. Exactly the failure mode both day 2 and today flag for MACD and RSI. There's no persistent direction for momentum to actually measure, so the signal sits close to noise. Once ADX confirms a real trend is underway, that same momentum reading becomes measurably more informative, as the IC numbers just showed. The trading rule of thumb that falls out of this: size momentum positions up when ADX confirms a trend, and down or off entirely when ADX signals chop. The signal itself doesn't change. How much you trust it does. What you're watching now is a live, monthly updating build of ADX-gated momentum confirmation on real NVIDIA data. 3 panels always moving together as each new month is added. Price runs across the top, with every CMO and ROC zero line cross-marked. Triangles for direction, circles for CMO events, squares for ROC events. CMO and ROC sit together on a shared dual axis in the middle panel, with the same markers repeated. And ADX, with its positive and negative DI lines, sits at the bottom, with dashed reference lines at 20 for filter and 25 for confirm. Every zero line cross is graded live by that day's ADX reading. Below 20 is filtered out and drawn as a hollow gray marker. Between 20 and 25 is caution, amber. At or above 25 is confirmed, solid green or red. Watch how many crossings get filtered out compared to how few get confirmed as the months accumulate. That ratio is the whole lesson. On the most recent bar, a bullish ROC zero line cross-up gets explicitly labeled filtered. ADX sits at just 14.3, while under the 20 filter line, so trend strength wasn't there to back up momentum signal, and it's discounted accordingly. ADX never generates its own buy or sell call here. Its whole job, made visible frame by frame, is deciding whether another indicator's signal has actually earned your attention. The vote count was overconfident. Our earlier strategy spotlight counted votes. 4 of 5 oscillators agreed. That slide's own caution flagged the problem. Here's how to actually correct for it. Here's the formula for effective N. Ineffective equals N, divided by the quantity 1 plus N minus 1, times rho bar, where N is the number of oscillators voting, and rho bar is their average pairwise correlation. Let's work an example. CMO, ROC, Williams %R, and SMI all flag overbought together. That's N equals 4. But they share the same underlying range and gain-loss logic. So their average pairwise correlation, rho bar, is roughly 0.65. Ineffective equals 4, divided by the quantity 1 plus 3 times 0.65, which is 4 divided by 2.95, which comes out to 1.36. For votes carry the statistical weight of barely 1.5 genuinely independent ones. Why does this matter? Redundancy inflates confidence. CMO, RSI, Williams %R, and SMI are all, at heart, different risk scalings of the same underlying idea. Where has price been relative to its recent range? Agreement among them is expected, not a coincidence. The honest question is how much new information each additional vote actually adds. DPO is different, and that difference matters. DPO deliberately measures something else entirely, detrended cycles from earlier this session. A DPO signal that disagrees with the other 4 adds real, low correlation information. A 5th range-based oscillator agreeing adds almost none. The fix, in practice, weight votes by 1 minus their average correlation to the rest of the group, rather than counting them equally, or, more simply, require at least one genuinely low correlation tool, DPO, or a volume signal from day 5, before treating Confluence as strong. From a reading to an actual cycle, DPO is the one tool this week built to remove trend entirely. Taken one step further, the spacing between its zero crossings gives you a genuine estimate of the dominant short-term cycle length hiding underneath the trend, not just a single oscillator reading. Here's the method. Cycle length is approximately the average spacing between consecutive same-direction DPO zero crossings. This is not new math. It's the exact same DPO from earlier this session. This only adds a ruler to the zero crossings you're already plotting. Let's work an example. DPO crosses upward through 0 on trading days 4, 18, and 33. The gap from the first crossing to the second is 18 minus 4, or 14 days. The gap from the second crossing to the third is 33 minus 18, or 15 days. Average spacing equals the quantity 14 plus 15, divided by 2, which is 14.5 days. So the estimated dominant cycle for this stock is roughly 14 to 15 trading days. A trader now has an actual number to work with. This stock tends to oscillate on a roughly 3-week rhythm, useful for timing entries within a longer trend, rather than simply watching DPO cross zero with no sense of its underlying rhythm at all. Regime conditioning the whole course, bringing day 1 stage analysis, day 3's ADX, and today's oscillators together into one systematic view. The same synthesis pattern you saw close out days 2 and 3, now one level more quantified. In stage 1, basing, ADX typically sits low, under 20, and momentum signal trust is low. Readings are noisy, and a fund keeps size small while waiting for ADX to rise. In stage 2, advancing, ADX is rising and typically above 25, and momentum signal trust is high. Trend is confirmed, so a fund puts full weight on the cross-sectional rank from earlier this session. In stage 3, topping, ADX is flattening or falling, and trust drops to medium. The discipline here is to watch for divergence in trim size, tightening up the volatility adjustment from a few slides back. And in stage 4, declining, ADX rises again, but now backing a downtrend, and trust returns to high, specifically for the short side of the ranked book. The synthesis, every advanced idea from today, collapses into one discipline. Never trust a momentum reading in isolation. Rank it against the universe, idea 1. Validate it with an IC rather than a hunch, idea 2. Scale it by risk, idea 3. Gate it by trend strength, idea 4. Discount it for redundancy, idea 5. And read it against the stage the stock actually sits in. Right here on idea 7, 6 separate disciplines, all converging on the same single momentum reading before you ever act on it. What you're watching now is a live, monthly updating build of the 4-stage framework applied to real NVIDIA data. 4 stacked panels, all growing together as each new month is added. Price sits on top, shaded by stage as it's identified, with a trend-following moving average overlaid directly on top of it. Underneath, CMO and Williams percent are each get their own panel with the same reference lines you've worked with all session. CMO's plus and minus 50 band, and percent R's negative 20 and negative 80 band. DPO sits at the bottom, explicitly labeled as the trend blind tool. It reads the short cycle, not the regime. Watch the shading flip color as the months advance. Those flips are the actual stage transitions, and the ones worth trusting are the ones where 2 or 3 panels shift in agreement at roughly the same time, not the ones where only the shading moves on its own. By the final month, the subtitle reports plainly, no stage flip this month. The stock remains in stage 2, advancing. Not a quiet month wasted, but confirmation that the convergence bar for calling a genuine regime change hasn't been met yet. Before we close out today entirely, 5 more questions for you to work through in your own notes. Answer them before continuing on to day 5. Question 1. Why does cross-sectional ranking solve a problem that a fixed threshold, like CMO above positive 50, cannot? Question 2. 2 stocks post the exact same 5-day ROC. Why might a fund still treat them as very different signals? Question 3. A signal has an IC of 0.03. Is that a strong or a weak signal on its own? And what does Grinold's fundamental law say a fund should actually do about it? Question 4. 4 correlated oscillators all agree. Why is that weaker confirmation than 4 independent ones, even though the raw vote count looks identical? And question 5. Why is ADX used to gate a momentum signal, rather than to generate one directly? Take a few minutes with these before moving on. Let's consolidate the advanced module into 7 takeaways. 1. Funds trade momentum relatively, not absolutely. Ranking a stock's ROC against the universe, rather than against a fixed threshold. 2. The information coefficient replaces "it looks right" with a measurable rank correlation between a signal and the return that actually followed it. 3. Dividing momentum by realized volatility makes it comparable across assets. The same ROC is not the same risk-adjusted signal. 4. ADX gates how much you trust a momentum signal. The same reading means more in a trending regime than in a choppy one. 5. Correlated oscillators inflate apparent confluence. An effective in adjustment corrects the naive vote count from earlier. 6. DPO zero crossings can estimate an actual cycle length, not merely a directional reading. And 7. All 7 ideas from today converge on one single discipline. Rank, validate, scale, gate, discount, and stage check every momentum signal before you ever trust it. Hold on to all 7. They're what separates reading an oscillator off a chart from actually trading momentum the way a systematic desk does. That completes day 4. You now know how to compute CMO, ROC, Williams percent R, SMI, and DPO entirely by hand. Read what each one is actually telling you about a stock's momentum, and going further than most introductory courses, rank momentum cross-sectionally across a universe. Validate a signal with a genuine information coefficient. Normalize it by volatility. Gate it with ADX. Correct a naive vote count for redundancy. And use DPO's own zero crossings to estimate a real trading cycle. Take some time before day 5 to sit with today's knowledge check questions, both the core set and the advanced set, and come back ready for volume and adaptive trend tools, Chaikin money flow, the elastic volume-weighted moving average, zero lag EMA, and parabolic SAR. Thank you, and see you in day 5. This has been Dreamlit Equity Research. A reminder that all content in this course is educational only and does not constitute investment advice from a SEC registered advisory service.